Okay, let me set the stage for this one. What if one single fund promised you enough monthly income to quit your 9-to-5 job? In this video, we'll discover the truth behind YieldMax's MSTY fund, or MSTY for short. How it works, what makes the yields look so high, and whether it can really give you a steady paycheck big enough to quit your job. We'll look at the risks and the hidden costs most people never think about. Keep watching. The final breakdown might surprise you. It shows why most people will never actually live off this fund, even though the payouts look massive on paper. What is MSTY and why is everyone suddenly talking about it? MSTY is part of the YieldMax family of ETFs. These funds don't invest in dozens of companies like regular ETFs. Instead, each one focuses on a single stock. MSTY tracks MicroStrategy, a company known for holding large amounts of Bitcoin. The fund uses an options strategy, mainly covered calls, to generate extra income from that stock. Because of this, MSTY often shows yields that look shockingly high, sometimes 40%, 50%, or even more when annualized. To someone tired of their 9-to-5 grind, that number looks like a golden ticket. But keep in mind, high yields grab attention fast, but there's always a hidden risk. So could these payouts really replace your paycheck? Okay, let's do some math. Imagine MSTY pays a 50% yield in a year. If you invest $100,000, that means around $50,000 in income. That's close to the US median salary. On paper, that looks like freedom. But the payouts are not fixed like a regular paycheck. They can change month to month, sometimes much lower. And if the stock behind it, MicroStrategy, drops in price, the income drops too. The paycheck dream looks steady in theory, but a little bit more shaky in reality. So let's bring in some words of wisdom from an old-time pro. Why does Warren Buffett warn that risk is the most expensive word in investing? MSTY's payouts depend heavily on MicroStrategy's stock price, which itself is tied very closely to Bitcoin. If Bitcoin fails, MicroStrategy's stock falls, and so does MSTY. That means you're not just investing in an income fund, you're also taking on Bitcoin-level volatility. Bitcoin can rise or fall 20% in a single week. Imagine trying to pay your bills with an income stream tied to that kind of roller coaster. High yield comes with high risk, and risk can wipe out your freedom overnight. So let's talk about the promise of monthly income. A lot of people love MSTY because it pays monthly. That sounds just like a paycheck. But here's the issue. That amount constantly changes. One month you might get $1,000. The next month you could get $400. Then back up to $1,200. That's very different from a steady salary you can plan around. Wealthy investors know the difference. They treat monthly income from these funds as a bonus, not a replacement for rent or groceries. A real paycheck is predictability. MSTY's payouts simply are not that. Let's discuss who actually benefits from MSTY. MSTY works best for people who already have stable investments. For example, someone with bonds, index funds, or rental income might add a small piece of MSTY for extra yield. That way, even if it drops, it won't destroy their financial life. But for someone who wants to put everything in and expect it to pay all the bills, that is a very dangerous gamble. MSTY is a tool for extra income, not a full paycheck replacement. So what about taxes? Do you really get to keep all of that income? Many people forget that payouts from MSTY are taxable. They often count as short-term gains or ordinary income. If you're in a 25% tax bracket and MSTY pays you $12,000 for the year, you might only keep $9,000 after taxes. That changes the numbers really fast. Tax eats into returns, and if you're relying on every dollar to live, that can be a very painful surprise. What looks big in your account shrinks once taxes take their share. What about fees? Do they come into the equation at all? MSTY has an expense ratio of about 0.99%. That's nearly 20 times higher than board-indexed funds like the S&P 500, which often charge only 0.05%. A 1% fee may not sound like much, but on $100,000, that's $1,000 gone every single year, no matter what happens with the fund. Over time, those fees add up, cutting into whatever income you earn. High fees quietly eat away at your money. How does MSTY compare to traditional income options? Think about bonds, dividend stocks, or even rental properties. Those options usually give lower yields but much more stability. MSTY flips that balance: extremely high yield but very low stability. For someone looking to actually replace a paycheck, stability is more valuable than excitement. That's why financial advisors often prefer boring but steady options for income planning. High yield without stability is like a paycheck that comes and goes. What happens if MicroStrategy stock crashes? Since MSTY is built around MicroStrategy, any big drop in that company's stock crushes MSTY too. MicroStrategy owns billions in Bitcoin. If Bitcoin falls 50%, MicroStrategy stock could also drop by half. That means your $100,000 investment could suddenly be worth $50,000. And because payouts are based on stock's value, your income would shrink too. One crash can erase years of income in days. Could reinvesting income make MSTY safer? Some investors try to reinvest the payouts back into the fund. The idea is to use compounding to grow wealth faster. But reinvesting only works if the underlying fund stays strong. If the stock behind MSTY is falling, reinvesting just means putting more money into something that's shrinking. That's the opposite of compounding. Reinvesting helps with strong assets, but with unstable ones, it just increases your risk. Let's explore why so many experts call high-yield funds a trap. High yields attract investors like moths to a flame, but many times those yields aren't sustainable. They may look huge in the short run, but when market conditions change and investors lose both income and capital. This has happened with risky funds before, and it could also happen with MSTY. High yield is often bait, and many investors don't see the trap until it's too late. Now, let's look at the possibility of MSTY still working for everyday people. The answer is yes, it can, but only in small doses. If you treat MSTY as a side hustle for your portfolio, it can be fun and even rewarding. Maybe it pays for groceries, gas, or a little extra night out each month. But making it your main salary is far too risky. It's best used as a supplement, not the foundation of financial freedom. MSTY can pay for small extras, but not your entire life. It's like the experts say, don't put all your eggs in one basket. Putting all your money into MSTY does the opposite of this. It ties everything to one company, one stock, and one risky plan. Real financial freedom comes from spreading your money around. Some in stocks, some in bonds, some in real estate, and maybe just a little sprinkling in high-yield funds. That way, if one falls apart, the rest can protect you. MSTY might fit in your portfolio, but only as a small piece of the bigger, safer mix. So to answer the original question, can MSTY really free you from the 9-to-5 grind? The truth is, while the payouts can be huge, they are unstable and risky. Depending on MSTY alone is like building your financial life on sand. It might hold for a while, but one storm can wipe it all away. Real financial freedom usually comes from multiple income streams, diversification, and steady growth, not a single high-yield fund tied to a volatile stock. Replacing a job requires consistent income, not just numbers on the page. To surmise, it's not just about chasing the highest yield. It's about building a strategy that survives both good markets and bad. YieldMax MSTY MSTY looks exciting and may give some extra income, but it's not a reliable replacement for a good old-fashioned 9-to-5 job. For most people, it's a bonus tool. not a full paycheck. One fund won't free you from the 9-to-5 grind. Only a balanced strategy can do that for you.